Hello, and welcome back to another episode of Reflections on Investing with the Cornell Capital Group. And we're going to do something a little different today. Rather than doing something analytical, we're just going to give you an example, but an example that we at the Cornell Capital Group think is very enlightening. Now, you might recall, particularly if you've been visiting our website, that we often quote Ben Graham when he says that in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And what we interpret that to mean, that in the short run, the market price of a security can be determined by a host of unpredictable things, by sentiment, by fads, by politics, by particular holders on Reddit thinking it's great, like GameStop. But in the long run, fundamentals rule. Let me give you an example. Back in 2004, Research in Motion, ticker RIM, and Apple had virtually identical market caps. And the RIM, if you don't remember, was the maker of the BlackBerry, which at the time was the leading business cell phone. But in the following years, Apple innovated and introduced the iPhone and took off. It is now the most valuable company in the world by market cap. And RIM, BlackBerry, is now essentially bankrupt. The fundamentals ruled. The market price of Apple reflects the immense success of the iPhone, and the market price of BlackBerry reflects the failure of the company's cell phone. So what I want to do now to just sort of underscore this point, that in the short run, it's Cathie bar the door. You don't know what's going to happen. In the long run, fundamentals rule, is just look at some recent history from the time period just before the pandemic began up through the present. So let's go over here to the computer and do that. So here we are. I have a graph here, and it starts in January actually, of 2020, before COVID, and it just runs up to the present. And this is a graph of the Standard & Poor's 500. And you can see from the beginning of 2020 through the current time, the S&P 500 has risen about 34%. Now let's look at some of the high flyers of the pandemic years. Certainly one of the most famous was Zoom. So let's add Zoom to the graph. Now you can see that to add Zoom, the axis had to change. Unlike the S&P 500, which now appears to have risen somewhat steadily to increase 34%, you can hardly see the COVID drop. Zoom just rocketed, rising to over 700% up in the middle of the pandemic, and now has come right back and basically matches the S&P 500. But Zoom is not alone. Let's look at some other companies. Let's add Peloton. Well, Peloton didn't go up quite as much as Zoom, but it suffered the same fate. It's now actually below the S&P 500. In fact, it's even below where it was prior to the onset of the pandemic. Here's Carvana. Didn't go up quite as much, but it's down here right with the S&P 500. Keep going here. Chewy, which is a popular pet tech company, same thing. Got up as much as 300% up. Now it barely matches the S&P 500. Shopify, the Canadian competitor to Amazon, once again, same picture, got as high as 300% up, now matches the S&P. Just a couple more here. Roku, the media company, same picture. It's actually below where it was in the pre-pandemic period. Wayfair, the online furniture company, right in line with the S&P 500 by the end. And finally, ARK, which is the fund run by Cathie Wood that sort of invested in a whole lot of the high-flying tech companies. And she looks exactly the same. She's now, over the entire period, slightly underperformed the S&P 500. Perhaps the most striking thing of this graph is no matter how high the company rose, they've all fallen back to basically match or even fall short of the S&P 500. And in some cases are worth less today than they were prior to the onset of the pandemic. Well, what do we take from this? I think we can go back to our quote from Ben Graham. In the short run, the market's a voting machine. And if we think back to the graphs we just looked at, the voting during the pandemic was for the high flyers. But in the long run, it's a weighing machine. And the long-term fundamentals were simply not there. And as time passed, the market came back into equilibrium and reflected those long-run fundamentals. So as an investor, you want to be very careful. Fads, hot stocks, great performance are not what you want to base your decisions on. You want to base them on long-run assessment of the fundamentals. This has been Reflections on Investing with the Cornell Capital Group.